Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of Upthinking Finance. Famous investor and money manager Peter Lynch once said, "Know what you own and why you own it." Today's guest represents a movement we've had in our firm for a number of years now to really seek out smaller, more nuanced investment managers. We think that the shift in markets and really the geopolitical climate we're in really requires a more of a personalized, customized approach to how we invest our clients' money. And to that end, I'm proud to introduce today our guest, Larry Reddell. He's a partner at St. James Investment Company. He oversees operations for the firm and is the manager and sub-advisor of the Absolute Select Value ETF, which trades under the symbol ABEQ. Larry formerly worked in the private client group at Goldman Sachs after graduating from the University of North Carolina, where he received his MBA. St. James Investment Company, which was founded in 1999 and located in Dallas, Texas, is an absolutely return-oriented, best ideas equity manager. Their philosophy focuses on valuation, independent financial research, fundamental research, and the view that risk is defined as a permanent loss of capital. So it's my pleasure to welcome Larry Reddell coming to us from Dallas. Larry, thanks for joining me today.
Appreciate the opportunity to talk.
No, you're welcome. So I guess to me, it's always important to get an idea of a person's background and how they ended up where they are. And so, you started at Goldman, and I'd be interested to kind of find out, what you liked, what you learned, and why you left, if we can kind of launch from there.
Showing my age, it was a while back that I joined Goldman. And at the time, it was a partnership. Private wealth was kind of very small, actually. And it was kind of an outgrowth of the institutional business just to help some of our wealthier clients. And what was neat about when I was going through the process, spent a lot of time training. We were not only in private wealth, we were developing relationships, but we were also building portfolios. There was no quote unquote open architecture that allowed us to tap kind of the best managers in different buckets. So we had to kind of be a jack of all trades. And it was a wonderful experience. I was there for about 10 years. And one of the big takeaways, especially when I joined the partnership, their motto, they said it to us again and again. They said, "We're greedy, but we're long-term greedy." And what that meant is that you always try to do the right thing by your clients. You try to be detail-oriented, thoughtful about your recommendations, and ethically untouchable. And by doing that, you would build the right kind of business over time versus making the quote-unquote short buck. So that's one of the big takeaways that stuck with me from Goldman.
That's an interesting point, because I think, honestly, that philosophy, just the whole idea of building and playing the long game, is really lost in our industry, at least on my end, my side of the desk, I think quite a bit. I got in this I got licensed in 92, started this company in 95, and it's a slow, long process of building. The idea of just acquiring firms to buy revenue streams never appealed. That never made sense to me, because, you don't know that the type of people you're bringing on are a fit. It just seemed kind of lazy, for lack of a better way to put it, anyhow, so, does that sound about right?
No, you're spot on. And you and I are the same vintage, Emerson. I look around at today's market that I think is casino-like, as evidenced by, double and triple leverage ETFs. Certainly some of the stories are harrowing about the way clients might get treated. And frankly, the market has been on such a tear since really '08, when we turned on the liquidity spigot. It's created a vastly different environment than what I would suggest is thoughtful investing. It's really become a speculative market, which is different than investing. That's not a It's not a moral judgment on speculation per se. Some folks are very good at it, but it's our strong feeling that what endures over time is being an investor, not a speculator.
Yeah, no, that's good. So you mentioned we're greedy, long-term greedy. I should have noted this, but when did you start working at Goldman? May I ask?
Started in '96 when I got out of my respective business school, and they kept us up in New York for about 8 months worth of training before we went to our respective offices. So I went to the Dallas Goldman office, and my partner Robert Mark here at St. James, he was at the Houston office, and it did, fortunately for us, breed some great friendships because of the nature of the training was intense. But at the same time, we obviously had a pretty good time in New York, as you might imagine.
Sure. No, that's great. So yeah, so you left then 10 years with Goldman, and then tell me about St. James.
Yeah. So, well, and Robert left earlier, and his background is military. He was really an engineer, but he was also a tank commander. And he got very interested in investing, as did I. And the books we were reading included The Intelligent Investor, some of Howard Marks' writings. And so it made sense and drew us both into Wall Street. He left a little bit earlier. He left in '99 when he founded St. James. And what we both noticed, although I came around to it a little bit later, is there was a drift in Wall Street in general from what we thought were the great tenets of investing as practiced by, say, Warren Buffett, and maybe the drive to sell product, if you will. And so St. James, and the reason it's called St. James is, Robert leaves Goldman at a young age, no track record. He's from a small town in Long Island called St. James, very modest people. And so the original couple $1 million that we started to manage was basically from that small town because they knew Robert's character. And we love to talk about the heritage of St. James Emerson because these are not folks who care about how they're doing relative to a benchmark in a short period of time. What they care about is they're making money and not losing money because we were trusted in many cases with the entire nest egg. And so to this day, whether it's something we do in the portfolio or how we write our letters and how we try to communicate, we think about those original investors, some of which are still with us to this day after 27 years.
I actually, I appreciate that view because, I left the bank I worked at and it was just a thought that came to my mind. I mean, I look back on it now and it's, I guess, sometimes there's something to be said for the ignorance of youth because everybody, and I just left because the thought was I could do better on my own. That was it. That was the motivator. But I still, like you, I had clients and I've looked back on it now. And I think as time goes on, the idea of stewardship, people trusting you with their funds, especially in the world we live in today, we pick up a lot of clients off Zoom calls. There's people, we have meetings, they make a decision to work with us. And then, we make a point, it's gone from coming into the office to going out, which is different for our, for the retail side. It used to be I'd have 4 or 5 meetings a day, come into our office in Long Beach. And now, we do these calls and we go out and see people. But I've still got clients, that took that leap when I left the bank, with the name behind it and all that. From, that's again, going back to people I met in '93, and that's pretty, that's humbling when you think about that, and most of our clients have been with us for 20 years on, average. It's humbling, for sure. And it's just nice to hear, people that know where they started and continue to respect that responsibility. Because like I said, I just, kind of agree with what you said from my own perspective that a lot of it just becomes, it's revenue oriented fees and growth for the sake of growing. And that's just, not how we operate. So, Yeah, no. So let's talk about the investment style, because that's another thing. I mean, you and I live in a world where, indexing and benchmarking, and maybe even if we want to explain that for people who aren't familiar with that, but there's a lot of things that have just steered people towards performance as the guide. And I will add into this, I assume you guys, from what I understand, your firm works with a lot of institutional investors where they've got to report to an investment, committee, and somehow evaluate your performance, so maybe let's get into that a little bit, if that's kind of making sense.
Yeah, well, a lot to address with that. But, just starting from finishing off who we are and right into the investment process. Um, as I think we've mentioned to you, Emerson, just like you, having our own business is immensely satisfying because we can do things the right way without potential conflicts. I believe as Jeremy Grantham talked a lot about, there is a conflict between being an investor and being a business owner. And it goes right to the heart of what you're talking about. If you're being short-term oriented, trying to keep up with the benchmarks, you might relax your process. You might do things that you wouldn't do with your own money, for example. You might invite a lot of risk because you're looking for that year-end bonus as a portfolio manager in a large firm. And we never want to have that conflict. And in fact, very deliberately, we only have one product. Select value is all we do, and it's what we do with our money and our family's money too. So we're very candid with people. We don't want to play the short-term game, which we think is very dangerous, especially in this particular market. And the track record we've built, it's really interesting, and it goes to the heart of what I think you're alluding to. We have a 27-year track record that's outperformed the S&P, and it's done it with the traditional measures of risk by Wall Street, about 2/3 the volatility, about half the beta. But really, the secret sauce has been when the market's euphoric and going up a lot, we tend to lag. We tend to not own the things that create the narratives and euphoria because our process is so rooted in valuation. But when the market sells off, we tend to do very, very well for the exact same reason. The companies that we own, it's easy to kind of understand the value that's there, and they tend to buoy. They might get caught up in some liquidity downdraft, but they tend to buoy very, very well. And so a couple just broad bullets. There is always a difference between price and value in a stock. And without getting into the nitty-gritty of our process, we try to exploit that delta. We try to buy opportunities where the value is well below the price, a classic margin of safety. And we do that by just, with a simple idea, or the simple understanding, I should say, every security, equity, bond, what have you, is just, the value is just the future cash flows discounted back. So if you can understand and appreciate the likelihood of those future cash flows, discount them back, and we use 10%, it's pretty easy to decipher value, at least for some companies. For story stocks and things that get caught up in euphoria, that's very difficult, and we tend to avoid those things. But we look for the obvious bargains. We don't know when the market will wake up to their value, but we sleep well at night knowing that the value is well above the price and at some point will be rewarded. And that, in hopefully a fairly succinct way, is what we try to do over here at St. James.
No, that's really good. And I mean, our kind of, again, I'm drawing parallels between you, the way you operate as a money manager, and the way we operate as kind of, a client advisor, I suppose, the people that take what you do and bring it out down to the downstream, so to speak, I guess. But the that's been our kind of opinion, my words, but when we meet with people, we tell them, exactly what you said. We're going to lag. We're going to lag in the up market that's being driven by the 7 or 8 stocks that are driving the S&P. But 2022 was a real win for us because, as an aggregate for the clients, we were down, less on the average retiree type of situation, no more than 6%, which was pretty good when the S&P's down 18 and the bond market's down 15. And we're comfortable explaining that. We're comfortable. That's our place in the world. People that are looking to chase, as you mentioned in another interview I listened to, narratives. Those things, that's just not where we fit. That's not, our place. And so we're comfortable having the conversation of why a client's up 8 or 10% in a 20% S&P market, because we get the other side of that conversation, which isn't as painful and also isn't as detrimental to their future. So I'm going to guess, and you brought up Jeremy Grantham and, that book he just wrote, the Perma-Bear,
Yeah, I haven't had a chance yet.
Yeah, it's you'll enjoy it because it covers a whole period of history. And, but he talks a lot about career risk. And I guess, if this isn't too personal, but it's interesting as heck to me is, when you have as you mentioned, and you have a conviction to an approach, and I'll appreciate the fact that your firm sticks to one thing. I think that says a lot because that says, we're not greedy. We know what we do and we believe in it. Have you ever been in a situation where you have to explain off to some of maybe these institutions you work with, why? I mean, and is that difficult sometimes? Why we're lagging?
I think there's a couple things. We actually don't have that much institutional money. It's more working with advisors like yourself. And I describe every interaction as we're not marketing, we're setting expectations. Because what we don't want, every advisor will have some collection of clients that are hypersensitive to relative performance versus the S&P. If they want their whole portfolio positioned that way, we're likely a bad choice. But you can always point at what we're doing and say these folks are doing what they told us we would do. And in fact, to your point, in 2022, we were actually up, which as a long-only manager, I'm not sure that should happen. I think that's an indictment of the market structure right now, and we can talk about that later. But there are these periods of time where our partners can see this is why we have an allocation to select value for St. James, or ABEQ, as you mentioned, because it does act like a ballast at a time where maybe bonds aren't going to do that, right? We've had 40 years of declining rates, and look, there's still a place for bonds. I'm not, but for the last 40 years until 2022, they have been where you get convexity. Well, I'm not sure that's the case anymore. I think there's some real structural inflation problems embedded in our economy. And the beauty right now is that this market is offering, it's bifurcated. You alluded to there's 8 stocks that are dominating not only the S&P. I mean, the top stock in Russell 1000 value is Google. These are the same names. The MSCI has a lot of the same names. Everyone owns the same stuff. And channeling my Jeremy Grantham, in the internet bubble, and if you just read the book, I'm sure this was highlighted. Grantham lost a lot of his assets sticking to his netting, saying, this is what our process is. This is where we see the opportunities. He did have a lot of institutional business, and they lost a decent amount of assets. The bubble collapsed, obviously, and those assets came, well, not the same assets, a lot more assets came back because he was rewarded for his thoughtful conviction. I would love that to play out. I don't know how that plays out in the age of QE, but we have held on to assets where a lot of other value managers have had to pivot or they've gone out of business simply because we are so candid about what we think we need to be doing. And it goes back to this is our money too.
Yeah, no, I love that. That's well put. And it really does come down to communication and knowing where you are, what you contribute, where you fit, and like you said, creating expectations. So I want to go back to, because I know you've mentioned when we first met with you, and I've heard you say in other situations about you're a very highly concentrated portfolio. And based on your, and I'm asking this because I'm wondering if there's a subplot here, the rest of us should be a little concerned about, because I forget you guys have what, maybe 20 to 30 positions in the portfolio. Am I right on that?
Right now, 23.
Okay. So that means if I'm extrapolating that out, there's a whole lot of places you don't want to invest your money, which mean, you know what I'm saying? I mean, that's kind of an opposite of everybody's concentrated in these indexes, like you said, and that's a great point. S&P, Russell, they're all, the tech is, the same companies are driving all this, which is pretty scary. Here you are at the other extreme, presumably shunning most of that, and you're over here with the few companies that perhaps aren't getting any attention. I mean, that's just my words, but.
Yeah, well, philosophically, we believe risk has nothing to do with owning your 70th best idea, right? So there's lots of opportunity out there. We just try to concentrate our firepower at our absolute best opportunities. And because our underwriting criteria are so specific, we don't feel, I mean, anything can happen, but we look for proven business models, rock solid balance sheets, high return on invested capital. So yeah, maybe something might happen that surprises us now and then, but for the most part, we don't need our 70th best idea to create a lot of alpha. And yeah, we're not shunning. I mean, I'll go back to the concentrated nature of the S&P. Those are great companies, with some exceptions, but those are great companies that top the leaderboard. It's just the price is so extraordinary. I mean, the valuations are priced for perfection. And part of that is the structure of the market right now. There's so much money in passive coming out of active that it just, every dollar, every time a 401k gets opened in a target date account, 8 cents, 7 cents of a dollar is going into NVIDIA, no matter what NVIDIA's valuation is. So we are exploiting, in our mind, this very, very top-heavy market due not necessarily to thoughtful valuation investing. It is due to just a structure that is perverted and providing us some awesome opportunities. And when we see an awesome opportunity, we don't mind allocating a decent amount of money to it.
So I think this is something we talked about before too. I mean, there's really no, this idea of style boxes, that this category. There was a time when that actually made sense to me, because it's like, okay, if you're building out this, this is there and this is here. And as time has gone on in life, and I guess we all get a little smarter the longer we hang out in this industry, you start realizing that, wow, the more limitations you put up, the more limitations you're working within, you're in a box. And, it's, from what I've gathered, you guys don't operate in that kind of world. I mean,
no, I mean, it kind of doesn't make any sense to us, right? Why would you buy something that doesn't offer value? I mean, we own Microsoft coming out of 2010 at $18, and we don't own it anymore. But, and if you're going to tell me Google or Alphabet is the top holding of the Russell 1000 value, I don't think they even know where their style boxes reside. So, I think a lot of value managers, what they did just out of sheer frustration, they allocated to a couple of the top growth names. This happened in kind of 2017, 2018. So it was easy to outperform the Russell 1000 value. And then in 2020, they got absolutely hammered, right? So look, the institutional big world of money management, they all play this game. The Morningstar charts make them play this game without any recognition of risk in our mind. And we approach things, we say right on the website, we're absolute return. We just put out money to make money. They're putting out money to say, hey, if the market goes down 20% and we go down 16, we're winners. And that's not how we're operating.
See, and this, I gotta get, I don't want to get on my soapbox, but no, I appreciate no, you know what? Because to me, there's an element of integrity there that goes along with that. And that is the willingness to, take a risk. And I started with, I think career risk is the term that came out that I've been sort of grabbing onto, but yeah, this this is, I don't know about you personally as a human being, but I've always been a guy from as long as I can remember that just shunned the crowd. Everybody's wearing this or that or doing this. I always was the guy who just inherently went the other way. That's just me. And, what I found in this business that, that's, you bring that up and people don't understand the risks that are present in those type of arrangements where people, where it's just an unmanaged index. It's capital, it's capital is that, weighted how you capital weighted, I guess, where the stuff just grows and skews. And then you get, I had a conversation with another gentleman on here a couple of months ago. We were talking about blind spots in the S&P. When you got 30 to 40% of your exposure in the tech part of the market, oil, real estate, a lot of these other things just aren't, they could go up, but they're not going to impact anything because they're so small. And so you're not diversified, and so that's kind of ironic that you can be getting a more thoughtful, allocation in a portfolio that you guys manage, your firm manages versus, this theoretically, these 500 companies. To me, all the rules have just changed. And I think that's where companies, for at least speaking again, from my perspective, where what you're getting and you can rely on that matters a lot. It really does. And it's not something I don't know, I can't say when that started to shift. I know for me, it shifted about, right after the COVID, but, and you know what I'm saying? I mean, is there, because you've been in this industry a long time. Have you just seen attitudes change? Let me ask you that, as far as your firm's business has grown, if I can ask, how has it shifted over the last, let's say 4 or 5 years?
You put out a lot of things I'd like to comment on. I'll start with just passive, because you said it well. It's not a risk we have a historical template for. But when Jack Bogle, launched Vanguard, he was posed a question. He said, what if everyone indexed? And he used the word catastrophe, because the intent of investing in an index is that active management would ferret out price discovery, and the passive we go along for the ride. Well, now it's been flipped. Over 2/3 of equity investments right now are in passive, and it's taking money away from active, so it continues to pile on. And that might be a reason to invest in passive, because it's just piling on and piling on. But there's some very smart people that would say at some point that's problematic. And for my money, I don't want to be anywhere near it, especially when I can find all this valuation, all these opportunities away from it that I think are far more compelling. So you talk about how things have changed. It brings up human biases and how it dominates how markets behave. Coming out of '08, you had a whole group of people that said, I'll never buy equities again. Right. And then you and I were both there for the internet bubble. I was an advisor, as we talked about. 10 quarters in a row, you're showing people losses. So '08 was harrowing, but it was over quickly. The grind of losing money over 2.5 years is psychologically damaging. Well, now what's psychologically damaging is not keeping up with your neighbor who's just killed it by, dumping a bunch of money into, you name it, the latest AI craze, or what Kathy Wood at ARK was doing not long ago. It is casino-like. And it's kind of ironic that some of the betting websites are now, kind of merging with what's going on in the stock market. But I don't get frustrated. It's truly opportunity, because here's the edge, and Stanley Druckenmiller talks about it a lot. And yeah, he's more speculative than we are, but he is an investor. He goes, look, I'm looking at 1.5 to 2.5 years. That's your edge, right? That by looking past what people are euphoric about now and trying to find the opportunity, because the rest of the market is so myopic, is so focused on quarterly returns, because that's how they raise assets. Just keeping your head down and trying to build a thoughtful portfolio. We believe in doers, albeit, we killed it from 2000 up to 2010. We've kind of lagged in the age of QE, but still made money. But we get these opportunities to demonstrate how resilient the portfolio is, and those kind of remind people why they allocate to us.
You mentioned Druckenmiller. Can you just remind me? A question comes to mind. Druckenmiller, and there's a story. He and I'm really cutting it out and paraphrasing it and whatever. But back in the .com. By the way, you're the first person I've had this conversation with that really describes the grind, because that's what it was. 08, 09, the world was ending, banks were failing. I mean, it was brutal, but it was pretty, concentrated, right? And that was just like every statement, every quarterly statement, like it just seemed like it would never end, And anyway, you look back on that, and I was like the battle scars of working in this industry, you know. But anyway, the short of it is, so Druckenmiller apparently, he knew in his gut that the .com was overvalued. He had brought on some intern or some other person that was handling this trading of a portion of their money and was killing it, buying all this stuff. And he finally gave in, and of course, when that happens, it's always at the worst time, March of 09 or March of 01 or 2000, and then of course lost a bunch of money in a very short amount of time. And so my question was, and again, I ask these things, and I never know if it's appropriate or not, but has there ever been a time, because I know, and I can offer an example for myself if I need to, but you maybe started questioning a little bit, or is it just, you're one of those guys who just, this works, we know it works, and that's the end of it?
Well, I'll answer it a little bit of a different way, but it does come with opportunity. I guess I'm showing my entrepreneurial optimism here. Since '08, I think it's important for people to appreciate that we've had any number of stimulus programs from both the Fed and more lately the Treasury that have boosted asset prices. And I'd argue we do have a lot of inflation, but sometimes that inflation has been asset price inflation, which everyone seems to like, assuming you have assets. So what's frustrating in our seat is the lack of willingness to allow the markets to work and have true price discovery. And now that there's so much debt, not only at the government level, but at kind of every level of society, it's kind of a political mandate that you can't allow, kind of things to clear, right? So if you think about recessions, what they have historically been is they're almost like small wildfires, allow the brush to clear, and then, you de-lever, and then you reset. And it's ultimately a healthy thing because it keeps economies from misallocating capital. And we've been intolerant of that since the great financial crisis through a variety of vehicles. And it's still going on, for sure. So that, I guess, would be our frustration, because when we've seen the pockets of opportunity, like before Liberation Day, this portfolio did exceedingly well. The first couple months of this year, this portfolio did exceedingly well. It's when you get kind of these lulls and it looks like there might be some deleveraging that we tend to really shine. But and I told you there's optimism on this. Uh, okay, if you acknowledge the things you can't control, and you assume the politicians will never, because they're telling you we're going to quote unquote grow our way out of debt. The things that we own, we think will continue to be, they have been and will continue to be rewarded. And they're things that are non-financialized, if you will, or hard assets for the most part, or just operating companies that are thoughtful about their capital structure and have real moats and real competitive advantages. So we very much had built a portfolio in mind to, in our mind, exploit the conditions set out by our politicians without taking part in what we see as kind of obscene valuations at the top of the passive vehicles, if you will.
No, that's a good answer. And I think actually you framed it really well because, for again, taking you as a component of what we build out for our clients, your firm now. And I'm really glad our paths crossed. That was, it's funny how things work out in life, and just,
Yeah, me too.
yeah, no, it's helpful because, we took the stance, and I may have shared this when we had our first meeting, but, my partner, Amy, that you met, she, we formed our partnership 3 years ago, but we've been working together for 8 years now. And she made the comment in a meeting, well, we don't know. We don't know what we don't know. And I mean, you go back a long ways. There was a time when, I would never say that in a meeting, I'm supposed to have all the answers, then I got really good. We subscribe to a lot of independent research, and I like it. I mean, it's, I like information. I like to get different views that aren't just tied to, as you mentioned, in the beginning or before we even got on, just about how a lot of firms are very product sales oriented and it's, transactional. I like, I like the knowledge, but at the end of the day, all the thing, you bring up the Fed and the fact that markets don't seem to be allowed to really function purely, I guess is my word. How do you manage risk, in a market like that? And obviously for us, we start planning for different outcomes. That's the only thing that's made sense to me, because I can't control what's going on in geopolitically, can't control what the Fed's going to do with money supply, the on and on the list, like you mentioned, all these variables. But I can control how we position clients, and I can control where we put the money. And that is the thing we have, some input on. And so the point of all that is it's as you said, it can be frustrating on one end, but on the other hand, it's the opportunity. And then you start keeping an open mind to new ideas and firms that are just doing things that have conviction a certain way. And it's like, okay, now we've got this base covered. And that's kind of the way my mind works. And it's, proven to work out for us pretty well. So, no, I appreciate that. I think it's good for investors to realize, what we're up against, certainly at my level, but even, more granular at the people that are making the decisions that are generating the returns that are showing up on their statements, right?
Yeah, well, I mean, there's a couple of quotes that come to mind. And, the first, Howard Marks is absolutely, in fact, his book, The Most Important Thing, I would suggest, is a better intelligent investor. It's more straight. It's easier beach reading, if you will. But he famously says, he goes, you cannot predict, you can only prepare. And so what that means to us as an investor is, if I put 50 smart people in a room, they get rolled out on CNBC, they're all going to say, well, in 3 months, the world will be like this, or 6 months, things are going to be like this. Nobody knows. Nobody knows, right? The Ghazi comedian. So what you do is you're prepared. Your risk management is preparing for more things than actually happen. And for us, we believe that our whole process is risk oriented first. So the way we managed money back in 2000 to 2002 when we did great, or that whole era before QE or started, it's all been this. It hasn't changed. I mean, we've tweaked some things to make the process better, but philosophically, we could be having this conversation 15 years ago, and it would almost mirror it. And because we believe, we contend that the tenets in which we invest, not speculate, invest, are rooted in things that have been proven over 100 years. But we're just in one of those environments where the market's going straight up. And if you look at the last 100 years of investing, you have long periods where the market is flat, 2000 to 2009. And you have long periods where the market kind of goes up, 2010 to now. And then are we ready for another kind of, market goes nowhere era? I don't know, but it doesn't mean you can't make a lot of money in that era. In fact, the last era like that, the market was flat. It was up 0.4% a year, and we were up almost 9, because we were willing to be a little bit different. And I guess I'm hammering the nail, so to speak, that right now, just kind of like after the internet bubble, you're seeing a lot of opportunity no one cares about. You brought up Emerson. I'm not talking too much. You brought up oil. I mean, what are the ingredients for AI? Chips and energy. Energy is 3% of the S&P right now. In 2009, it was 10. I mean, there are unloved opportunities that we would argue are very well positioned for the next 10 years under a variety of scenarios, including a very growthy scenario.
Yeah, no, this is great. Gosh, I could talk to you all day about this stuff because, I mean, it's just.
Yeah, I traffic in it a lot, which is it's my natural curiosity and a privilege of the job.
Well, no, you know what, though? It's important because these are the battles that, as an investment manager, as a client advisor, getting because it's difficult. Well, you mentioned CNBC. I mean, to me, the financial journalism is just, mainstream financial journalism, the evil ones. I mean, it's brought everybody down to this day-to-day mentality, which seemed to happen right around the .com is when I kind of noticed it. And so, when you start talking about these long-term, views where you're going out 10 years, intellectually people get that, but gosh, getting from A to C, B can be a very big distraction with news and with underperformance at times. And, the latest this and that, there's just so much noise and out there that, it's a real challenge just to, to stay the course for people. And, but again, that's why it's important to have people like you that see this and have conviction of things, because it makes it easier for guys like me. I guess the last thing, as we're winding up here, just your thoughts on where we're headed. You brought maybe one thing I'll throw out, and then anything else you'd like to add before we end is you mentioned the debt. And I've had this conversation with so many people because, I have back in early in my career, people would ask about, what about the debt, and I'd be like, well, what about it? And it doesn't seem to matter, and as the numbers get bigger and larger, and then you start reading about these GDP levels all over, Japan and France and all this stuff getting worse and worse and worse. I mean, where do you see that one going? Because you could argue it still doesn't seem to matter, you know what I'm saying? I mean, it's what's changed other than the number in terms of, acid bubbles and acid growth. Where do you see that one going? Maybe anything else that's just kind of on your mind as we move ahead over the next 4 or 5 years?
Yeah, I alluded to it. I mean, they're telling you what they're going to do, right? They have to grow out of the debt, although the deficit is growing faster than we're growing. But the choice of actually trying to default to restructure the debt is not a politically viable one at all. So they're telling you what they're going to do. Now, who gets rewarded from that ultimately? I mean, we're one of the few managers out there that have owned some precious metals over the last decade. And people will be surprised if you say, well, what's done better, the S&P or gold since 2000? Gold has trounced it. And it's not that gold itself is great. It's that the money supply is growing at a way that's not reflected in the CPI because it's a heavily tortured statistic. So the point is, look, anything can happen, and certainly we're going from we're going from globalization to deglobalization. which is another big theme of ours. And if you kind of think back to the war in Ukraine when it started, a couple of really important things happened. And we're seeing it even more so with the other conflicts we have going, namely Iran. We confiscated the Russians' euro dollars when they invaded Ukraine. And by virtue of doing that, we sent to the rest of the world, we said, you know what, if you do something we don't like, we're going to take your stuff. And so central banks have been buying gold and getting rid of bonds, which is not great for us. The second thing the war laid bare is, we're using Patriot missiles, which cost $10 million to intercept drones, which cost next to nothing. Patriot missiles take years to build. And by the way, we're heavily reliant on China. So, deglobalization is very much a national security issue. And industrials, select industrials, we think will be rewarded. And then you think about materials that come from abroad. I mean, we are trying to throw into reverse as a country what we've been setting up since the late 70s. And I don't say that to be sobering, although maybe it is. I say that to say there's a lot of opportunity to be a thoughtful investor as the world gets reshaped through this, and hopefully not reshaped not too violently. But I've alluded through our whole talk, Emerson, you got to have assets, and I believe you got to have hard assets. We define that fairly broadly. Economic engines that do well in a variety of environments, things that can't be printed away. We've always been kind of allergic to the banks. Not that banking isn't a great business, but it's hard to get through the balance sheets. It was in '08, and that saved us, and it still is now. So we definitely have some things we gravitate to for exactly the reasons you're alluding to. The world's changing in a pretty profound way, and we're trying to be a little bit ahead of that.
No, that's great. Thank you. I got to tell you, it's just refreshing to talk to people like you, and you're in good company, by the way. You're the third person in the last 12 months that's brought up the rush that America weaponizing the dollar. When you mentioned it as being a defining moment economically. And you don't hear that a lot, but when you mentioned about seizing Russian, dollars, and that's changed. That's been a catalyst for change that doesn't get a lot of run, but it's valid.
It does abroad. Obama did it to the Iranians in his administration, and the Chinese took note right away. But they're the Iranians. When this happened to the Russians, the world took note. I mean, if you're not a G7 country, if you're India and you want to trade with Russia for oil because you need to feed your people, you cannot be dictated to by the United States. And so, everyone is slowly, thoughtfully getting away from the dollar. It's not to mean the dollar goes away, but the dollar's not, it's still a medium of exchange and will be, but not necessarily a store of value. Central bank assets gold has now exceeded dollars, essentially, across the world.
No, that's another thought I haven't heard. A store, it's not a store of value. It's a means of exchange. A means of exchange, but not a store of value.
Yeah, you'll get into these arguments, and I think it misses the point, right? So what is a currency? A store of value and a medium of exchange. And I think some folks will rightfully say, petrodollar is not going away. The world's relying on it, and it is. It's liquid. It's easily transactionable. It's the way the world is set up right now. But there's a problem of trust for sure in terms of store of value. Not only because of the confiscation that I mentioned, but just what we're talking about. We are printing our deficit spending is just the interest alone on servicing our debt is squeezing out the rest of the pie at an alarming rate. And all that means, though, is that the value of your purchasing power is going to continue to go down because it needs to for us to keep the boat afloat.
Larry, like I said, I could talk to you all day.
Well, I could too. I love these conversations, and I'd probably talk too much, but you're kind to have me on for sure.
No, I appreciate it. So listen, I want to thank you for your time today, and just look forward to another conversation again in the future. And thanks for joining me on Upthinking Finance.
Thank you so much, Emerson. Appreciate the partnership, and let's do this again soon.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.